Hey guys, welcome back to Reserved Investments on YouTube. It is 2 o'clock in the morning and it's story time with Sean. I'm going to read to you a couple of sentences from this excellent book, and then we're going to talk about it in depth, and we're going to apply it to the modern era collectible card game market. The market for Pokemon, market for modern era sports cards, Magic the Gathering, Yu-Gi-Oh!, Flesh and Blood, MetaZoo, and the like. Because there's a lot of you younger collectors, a lot of the people that are coming into these markets with dollar signs in their eyes, thinking that all these markets go exponentially up over the long term, are missing. And again, we got to take a step back before we go any further, because we have to have a candid discussion about this. Because my inbox right now, my email inbox is full of questions about buying the dip in collectible card games. And a lot of you guys are really seeing this all wrong. So without further ado, a lot of card dealers who didn't get out of the game early enough took a beating. They all put product in their basement and thought it was going to turn into gold. One survivor told me. The dealers, the card companies, and the players had all helped to kill the golden goose, flooding the market with more than 100 different card sets. Kids felt overwhelmed. The industry started to cater almost exclusively to what a Beckett Baseball Card Monthly employee described to me as the hardcore collector, an older male, 25 to 54, with discretionary income. Manufacturers multiplied prices across the board and tantalized collectors with limited autographed gold foil slathered cards. Baseball cards were no longer souvenirs of your favorite players. They were elaborate collectibles that happened to have ball players on them. Of course, the great crash of 1994 had been preceded by a boom period of wild speculation. What I am reading to you now is from the incredible book entitled Mint Condition: How Baseball Cards Became an American Obsession, written by Dave Jamieson. This book came out in 2010. Make no mistake, I don't even know Dave Jamieson. I get nothing from the sale of this book. If you want to read it, read it. If you don't, hey, you do you. But I'm telling you right now, what is happening in a lot of these collectible card games, what is happening right now in modern era sports cards, we've seen this all before. The manufacturers just get better at propping out these products to the Timmies, Kimmies, Poindexters that'll buy it, hold it in their basements, hold it in their storage units, hold it in the spare bedroom, thinking that one day it's going to turn to gold. I've said this a million times before, guys. If everybody is buying this stuff, if everybody is hoarding it, who are you going to sell it to? Right now, you guys are utilizing the greater fool theory. When your favorite Pokemon set of the modern era goes up in value, what happens? You can easily pull it out of your closet, you list it on eBay, and you sell it to the next greater fool. That fool buys it, puts it away, hopes that another greater fool comes along and wants to pay more for it. That's how this market works. There are no fundamentals. There is no intrinsic value. You know, I hear a lot of young YouTubers coming on the scene, and they're really fascinated with Pokemon, or maybe it's video games, or maybe it's comic books, and they're putting together all of these investment videos, all on collectibles are going to the moon, collectibles are going to Mars, they're going to Jupiter. Well, in all honesty, I honestly think that a lot of these markets are going right up your anus. They're going to miss Mars, Jupiter, and the moon. And, you know, I don't know about you. I don't want a Pokemon card up my anus. It just doesn't seem too fun. It's almost like getting slapped in the face with a gluten-filled donut. We talk about that a lot in this channel. So what I'm saying to you is, guys, you got to take a step back and you got to learn the fundamentals. So now that we're 4 minutes into this, I already gave you a book to read, even if you don't have any interest in baseball cards. Believe me, guys, I am not a sports fan. I do not sit at home and watch football games, baseball games, none of that. I go to museums, I go hiking, I go weightlifting, I go and do other things. I'm not into sports per se, but I will tell you, this is probably one of the best books written about speculation in the antiques and collectibles trade. And a lot of you, I know for a fact, are not reading it. And if you want to learn these markets, this is one of the best books to read on the topic because we've already seen this all before. It happened back in the 80s. It happened back in the 90s. Then in 1994, the market crashed and it was transformed forever. Now, to be fair, for those of you watching this video, Sean, yeah, we know you've always been hypocritical of Pokemon. You've always been hypocritical of Magic the Gathering and some of these other collectible card games. Again, let's do a quick review. There are three markets that govern the entire antiques and collectibles trade: speculative, established, and mature. I assure you, Pokemon cards that came out in 1998 and Magic the Gathering cards that came out in 1993 are not established and they are not mature. They are on the speculative side of the trade. You cannot compare Pokemon cards, vintage or modern, to rare coins, to artwork, to investing in fine wine, to investing in vintage watches. Those markets are all either established or mature and sophisticated. Those markets have a track record in some cases of hundreds of years. The Pokemon market came out in 1998, not in 1798, guys. Some of you guys are giving it more credence than it deserves. That's not to say there is not opportunity in that market over the long term if you buy right and if you really study the market. But again, I got to state, most of you out there, rather than attempting to buy the dip in cryptocurrency or Pokemon cards or Magic the Gathering, would be better off putting your money in a standard S&P 500 index fund or a total stock market index fund. And today, I'm going to tell you why. This comes from the Motley Fool. Now, I don't care whether you like the Motley Fool. I don't care whether you hate the Motley Fool. The Motley Fool did an excellent article. Why is it important to invest in stocks? And I'm going to read this to you because it sums up perfectly what I have been trying to say all along on this channel. Before you put all of your money in alternate asset classes, I don't care if you're going after oil, gold, silver, cryptocurrency, collectibles, Pikachus, Marios, Sonic the Hedgehogs, whatever it is, even rare coins, even artwork, you need to either be financially established or you have to have a plan in place where you are working to become financially established. The best way to do that is through the stock market. Now, notice I did not say buy individual stocks. What I am telling you to do, especially if you are young, meaning if you are under 50 watching this video right now, and you have no exposure to the stock market at all, you would be better off investing, again, in a total stock market index fund or an S&P 500 index fund. And here's why. According to this article, which I agree with highly, the stock market has created an enormous amount of wealth over the years. Investing in stocks on average, the S&P 500, which includes 500 of the largest U.S. publicly traded companies, has returned 8 to 12% annually. Only $10,000 invested in the stock market 50 years ago would have grown to more than $380,000 today. However, be aware that the stock market doesn't go up every year. The S&P 500 typically falls 3 out of every 10 years. Some drops can feel quite brutal, and its level of volatility is not for everyone. But if you can manage your fear, stocks have the potential of earning significantly higher returns than other investment options over the long term. To be fair, the only asset class that compares to stocks over the long term that I've ever encountered is real estate, if you are buying it to rent out. Now, benefits of investing in stocks. There are many benefits to investing in stocks. The potential to earn higher returns. The primary reason most people invest in stocks is the potential return compared to alternatives such as bank certificates of deposit, gold, and treasury bonds. For example, the average stock market return has been about 10% annually since 1926. Now analyze that. Go back to 1926. That was before the Great Depression. That was before World War I. That was before World War II. That was before all the craziness we're seeing right now in the year 2022. How many recessions, depressions, how many people told you it's all going to go to zero in that time? The people that buy and held the stock market end up making the most money over the long term by tuning out all the noise. A lot of you guys have it opposite. You go, you know what I'm going to do? I'm going to tune out that reserved investments guy because he keeps warning me about Pokemon. I'm going all in diamond hands. That is the dumbest plan I've ever heard. Please read this book. Now let's continue with this. Another reason to invest in stocks, the ability to protect your wealth from inflation. You know, on this channel, I've done about 2 videos on understanding collectibles and their relationship to inflation. And ever since that time, people still reach out to me. Sean, you got to do more videos on inflation and collectibles. We're heading into a period of high inflation. Sean, the period of high inflation is here. Consumer Price Index says that we're at 8.6%. It could even go higher. You got to do more videos on this. And what is it that I tell you guys? The stock market is one of the greatest ways to protect your wealth against the ravaging effects of inflation. Now, a lot of you guys don't want to hear that. So this is what the article says. Stock market returns often significantly outpace the rate of inflation. For example, the long-term inflation rate has run about 3.1% annually since 1913. You understand that is an average. That's a running average. Since 1913, inflation's been about 3.1%. That compares to a double-digit annual return from stocks. Stocks have been a good way to hedge against inflation. I've been saying that all along. Here's another good reason. The ability to earn regular passive investment income. And I've said this many times on this channel. Sitting here with a box of factory sealed Pokemon cards does not pay a dividend. It does not pay any type of an income stream, any type of passive income stream. If you want to convert this to cash, you have to sell it in the open market. And we all know the market for collectibles, regardless of what the 20-something Pokemon people tell you, is less liquid than that of Wall Street and financial assets. So many companies, as I've talked about many times before on this channel, pay dividends or a portion of their profits to investors. The majority make quarterly dividend payments, although some companies pay monthly dividends. Dividend income can help supplement an investor's paycheck or retirement income. And no, I'm not going to tell you how much I earn off of dividends alone from my several financial portfolios that I have, but let's just say it's quite substantial, guys. In other words, it almost compares to what I earn in my corporate job. It is that substantial. The pride of ownership. A share of stock represents fractional ownership of a company. You can own a tiny slice of a company whose products or services you love. Liquidity. Most stocks trade publicly on a major stock exchange, making it easy to buy and sell them. It also makes stocks a more liquid investment compared to other such options, such as real estate and collectibles, that you cannot always quickly sell. Diversification. You can easily build a diversified portfolio across many different industries through stocks, ETFs, and mutual funds. That can help you diversify your overall investment portfolio, which could also include real estate, bonds, cryptocurrency, collectibles, reducing your overall risk profile while improving your returns. Now, before we go any further, once again, I'm not advocating that Timmy, Kimmy, or Poindexter Jr. goes into the market and starts investing in individual stocks. Individual stocks are inherently risky when compared to exchange-traded funds, when compared to either actively managed mutual funds or index-based mutual funds. If you are new to starting out investing and you have a long time horizon, more than 10 years, I encourage you to start with index-based mutual funds. The two that I recommend are either the Total Stock Market Index Fund or the S&P 500 Index Fund. Now, with that being said, there are risks to investing in stocks, just like there are risks to investing in Pokemon or rare coins or artwork or cryptocurrency or silver, gold, real estate, whatever it is, there's always going to be risks. So these are what they are for those of you that reach out and ask me this question. You cannot stomach the thought of a 10% or greater decline in your investment. I'm here to tell you like it is, guys. Over the last couple of months, obviously, if you're holding any of these financial assets, yes, you are seeing a decline in the value of your portfolio. However, if you're not selling anything, it is only temporary. Eventually, when the economy gets back on track and inflation is no longer a threat, and we've already gone through this upcoming recession that we're most likely going to encounter, what do you think is going to happen? The value of your holdings is going to go back up in value. You need the money within the next 3 to 5 years for a down payment on a house or some other large planned expense. Please, guys, if you are saving for a big purchase, whatever it is, if it's a car, if it's a house, do not put that money that you're going to need within the next 3 to 5 years in the stock market long term. It is most likely not going to work out for you. The stock market is for long-term investing, usually 10 years or longer on average. Some people will tell you 5 years or longer. I usually, when we start talking about index-based mutual funds, I like to tell people at least 10 years, preferably 20 or more. If you are retired or you're nearing retirement and need a fixed income stream more than the capital appreciation potential offered by stocks, please do not invest in the stock market at present time. So if you're one of the people that watch me on YouTube and you are 70, 75 years of age, hell, 80 years of age, it probably most likely is not going to benefit you right now to start investing in the stock market, because when we invest in the stock market, we need time on our side. That's why all these 20-somethings that are coming to YouTube saying how great the Pokemon market is, and it's just going to go to the moon and the sky's the limit, they don't understand that they are giving up the time value of money that is most important to them because they are young. Money compounds. The earlier you start, the more money you will end up with. Now, beyond volatility-related concerns, there are other reasons to avoid stocks, and I want to be 100% clear here. You have a lot of high-interest debt, like credit card debt. Paying off this debt usually can yield a higher return than buying stocks, especially when you guys come to me, and I do have people that tell me this. Hey, Sean, I got caught up into the hype of Pokemon or Magic the Gathering or video games or comic books, and I put it on a credit card that's costing me 12, 14, 16, 18% interest per year. That is 100% insane, guys. Please sell the collectible, pay off the credit card, get out of debt, get yourself financially established. Then if you want to tell me, hey, Sean, I'm financially established, I decided to put my money in factory seal booster boxes of battle bonds, feel free. Am I going to laugh at you? Well, it depends on what price you pay for this. By the way, guys, I got these at a very, very low price, so I took advantage of it. Now, that being said, you have to use common sense in these markets. Another way or another reason you should avoid investing in stocks is if you do not have the necessary cash cushion to withstand some type of financial emergency. Now, let me tell you the truth about people who have a lot of money. Most people that have a lot of money, believe it or not, do not really have an emergency fund. Most of us either get so many different income streams on a regular basis, or we have money invested in the stock market to the degree where every so often we're getting a dividend out of that becomes our emergency fund. So really all we're doing is we're investing everything that we have, and the income stream that comes out of that becomes part of our emergency fund. So most high net worth individuals, like if you have a net worth over $500,000 or more, most people in that category, they do not have like money put away just sitting in cash. Most people actually like that money to be invested because you can get a higher rate of return. What are you going to get in a bank savings account? What are you going to get in a certificate of deposit right now? Hell, what is the average bond paying right now? It's not worth it to keep money in those type of assets when you can put it in dividend income producing items or investments, or you can put it in real estate that's generating returns month after month, cash flow. Guys, that's all I want to say in this particular video. And we're going to go forward on this. Don't worry, I'm not going to leave you hanging. We're going to do more videos on collectible card games. But please, Learn the risks. Understand why investing in Pokemon is not on par with rare coins, and it's certainly not on par with investing in stocks. Please do not be a Timmy, Kimmy, or Poindexter. Please take the time. If you do want to invest in cardboard, there's nothing wrong with wanting to divert assets to the antiques and collectibles trade. But please, take the time to read this book, Mint Condition, by Dave Jamieson, How Baseball Cards Became an American Obsession. And you're going to see parallels in what a lot of these companies are doing right now in the overall collectible card game space, in the overall modern era sports card realm. We've all seen it before, guys. It did not end well. Thanks for watching. Have a great night.